Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop from Pure Property, back in the studio for our monthly instalment of gibbery and Tom Jokery on the most anticipated podcast in Australia. Paul Glossop, how are you?
Mate, I'm excellent.
Yeah.
I am absolutely excellent. It's as good as I felt going into a June for a number of years. And I think it's probably because we've got a lot of clarity this year versus probably the last 2 or 3 years, which have been shrouded in secrecy and potential elections and interest rates going up, down, sideways, inflation out of control, back into control, Trump in business, Trump out of business. It's
Still tariffs now.
Still tariffs. Just I think that was only this week, wasn't it? The 50% started. So there's certainly still some uncertainty out there in the market, but from a property standpoint, it's for anyone who's got that sound of the old school poker machines going 777, ding, ding, ding.
Lemon.
Probably not property lemon, but
No.
but essentially it's. I think it's starting to become a lot clearer as to what's going and what is happening now.
So the feedback's been off the chart from our series of the Fast 50 that we did a couple of weeks ago. So this report, and it's not what we're here to talk about today, but I'm going to use this opportunity to give it a plug. Where to put your money today for the best capital growth in 2026. The report is live. It's been out for a couple of weeks. It's getting downloaded from people right across Australia, but also there's a lot of global downloads, which is good to see. We did a whole series of podcasts around it. You can, wherever you're tuning into this podcast, go and listen to it. 6 installments of a special series on the Fast 50. We spoke about the states. We spoke about regional metro. So go and check it out. If you want to have some guidance or sense for where you should be directing your dough, this report may help. You can go and find it at smartpropertyinvestment.com.au. Go and check it out. But that's not what we're here to talk about. We're here to talk about what's going on in property, what's making property news. And this is where we put our special jingle in. So I'm going to hand over to our jingle makers. Stand by.
What's making property news?
Right, welcome back. That's what's making property news, and this is where you come to make sure you know what's going on. Now, Paul, I've got a couple of things I want to talk to you about, but something I've been musing about. It's just only the other day. There's a whole bunch of things going on globally, right? All around the world. There's ongoing conflict in Ukraine. There's challenges in Europe. There's a flight towards conservatism over there. You've got what's going on in America with Trump. You've got change of government, Gaza, Israel, change of government here in Australia and in Canada, for example. You've just had all the defence people over in Singapore getting together to talk about sort of security in Asia. You've got people talking about war potentially in Taiwan and all this sort of stuff, right?
Heaps.
And I'm right across it because it sort of feels in the orbit of some of the things I do in work. But as your average property investor, if that thing exists, does any of that stuff matter if you're making property investment decisions?
It's funny, Phil, because I almost throw this back to you, mate. Like, you've been doing this for a long time. You've worked in a business that generates articles, media, journalism, essentially, surrounding a lot of those topics that you just brought up, whether it's property, whether it's defence, whether it's global, essentially funding, banking, and a whole range of other things to do with geopolitics. I don't know if it's a mechanism of the fact that we're just obviously so much more immediately connected anymore these days versus where we were even 5, 8, 10 years ago, certainly more than obviously 20 to 30 years ago. And we know as citizens a lot more than probably what we actually might have actually even known what was happening 5, 10, 15 years ago. Because I feel like the older I get, the more I know, not because I think I'm wiser, probably because I'm getting fed immediate information. The challenge comes as property investors is that if you made your decisions based on the information that was fed to you every day, you'd be selling everything, including the kitchen sink, and you would probably sit in a corner and just shake yourself to a withering, slow, and horrible death because you'd think there is no upside to life. yes, there's so much uncertainty, and you're right, Phil. Like, I don't know in my life that I've felt so much closer to uncertainty as a country, and the fact that Australia could and potentially will be drawn into a whole range of these different conflicts in different ways more than I ever have, and that's living through a range of different conflicts over the last 4 or 5 decades. But is that a reason that property is going to underperform over the next 5, 10, 15, 20 years? Well, if it was the reason, it hasn't necessarily prevailed ever in the past. And when I say ever, I mean ever. Property has gone up in value. Demand has increased. There has been no shortage of conflicts that have impacted the world, certainly has impacted Australia, and not just Australia as a whole, potentially in certain different areas. We've got downturns in China from a demand perspective. Is that going to see a huge downturn in WA because of iron ore prices, lithium prices? Maybe. Is that sustainable? Likely not. It fluctuates. It's cyclical. Most of these things that happen are cyclical, whether they happen within 12 months or over 10 years. They happen in isolation, but what we find over time is that property tends to always move in that same direction as long as you stay in the game. So if you observed what's happening day in, day out, and you made your decisions based on that, you certainly wouldn't be making many. I wouldn't be making many. And this year alone, I've made more personal investment commitments property-wise than I ever have in my life. And that's based on the fact that I'm confident in what is happening and what I expect to happen over the next 5, 10, 15 years, well beyond what else I can put my money into, put it that way.
Okay. Well, it's reasonable sort of response and attitude to it. I'm probably across and aware and connected more than most people in relation to all these different things moving on, whether it's the economy, whether it's politics, whether it's defence, whether it's security, whether it's all the bad stuff that's going on in the world. And it doesn't really change my investment decision making. Like, it does. Okay, I know and I'm aware and I'm conscious about it. This just runs in parallel.
Yeah.
And you need to be comfortable with that, right? Because you would, to your point, absorb yourself with so much information that would just stifle your ability to make decisions.
Yeah, and there's enough information take out of the equation. Anything to do other than with just property information, there's enough in that in itself to stifle your ability to actually take action.
Yeah, and if it got to the point where, as say there were to be, and it depends what side of the argument you sit. If there were to be major conflict in our region, and what we're talking about there is within the Pacific, it would be such a different set of rules that would shape the way in which Australia responds and how Australia's property markets would react and respond to that. It would be, the only analogue you would have towards that was the threat that Australia felt it had in the early 1940s with an expansive Japanese force coming down into the Pacific. That's the closest you would get to any sort of analog towards it. Yep. And I don't know what property prices did back then during the Second World War. We could go and have a look at it. But irrespective, it's sort of moved on from there. So
well, there's a few things, and I'll take this back. It's funny you say that, brought this up now, Phil, because I was at a dawn service this year for Anzac Day at my local dawn service, which is actually now a very big dawn service. And it's on the beach down in southern Sydney. There's 10,000 people who go to it these days. It's enormous, right? Becoming one of the biggest dawn services in Australia. An amazing dawn service this year, super still, calm ocean. They had a projection of photos from World War I and just some archival, black and whites from the area. There was some photos that I saw which I was completely unaware of, which had barbed wired 2 rows of razor wire and barbed wire on Cronulla Beach, up and down it, right up to the edge of Voodoo. And, we're talking a couple of kilometres of beachfront here to stop an invasion. And in my mind, I thought, holy heck, this was, there are still people alive today who essentially were close enough to that action to know that we weren't far from this ever happening. Yeah. And you're kidding yourself if you think that. I mean, look, conflict and war will no doubt change, and it's a horrible thing. There's rarely any winners out of it, but it doesn't mean that it's not going to happen. And you're living in a bubble if you think that we're completely isolated. If anything, Australia is probably more connected to all of this now than we ever have been. But if you look at what happened during that time, during World War I, World War II, and all the other wars that have happened after that in Australia. One thing we've always need and will continue to need is shelter. Our population has continued to grow. There is more demand for property and there is less property being constructed for those people who want to live in it. It is a necessity. And the reality is it doesn't necessarily matter what happens across the world. As long as those fundamental components stay, the demand for property and housing will stay and the value of property will continue to increase based on those demand factors.
And this is this debate that I've been cultivating, that everyone talks about critical infrastructure in Australian critical infrastructure being mining, fuel security, agriculture security, transport infrastructure, banking. These are all, energy. These are all critical infrastructure. The fundamental critical infrastructure for all of Australians that's relevant to all Australians is housing.
Yeah.
It sustains our economy. I think 1 in 8 jobs in Australia is directly connected with property in some capacity, and that be trades and everything connected in with it, right? It's the backbone of our banking system, which is regarded globally for our major 4 banks. For some reason, are some of the best banks in the world, even though we're a tiny little nation down here comparatively. A lot of the dough that sits in Australians' superannuation is in bank shares. It's absolutely critical. The banking infrastructure connected to real estate in Australia, it's massive, and it goes to that point. Irrespective of conflict. But who knows? Let's hope there is not a significant conflict in North Australia. It would be horrible to see. But it's got in a lot of conversations. So the question was, does it change whether or not you should invest in one suburb over another? And even in World War II, Australia, Sydney, had conflict in Sydney. I think that even Sydney and Newcastle were shelled.
Yeah.
So
we only found subs, less than 10 years ago that were unfindable.
And people moved.
Yeah.
I think there was one night when I think the eastern suburbs got shelled or something or other, and people sort of started moving out.
Yeah, absolutely. They were fearing the worst.
And it's crazy. But, whether or not that happened. So that was a question. So don't absorb it. You put it on BBC or the CNN or anything. You can sit there and just put your head in your hands and go, mate, the world's gone to...
I still don't know anywhere else I'd prefer to be at this stage in my life. And
a property investor in Sydney.
A property investor, but just an Australian citizen living in Australia, particularly personally, selfishly living in Sydney. But you and I have travelled a lot, Phil. We've lived in a lot of places, good and bad, with money, without money. And I still don't go back to my memory archives and think, man, I wish I could just sell up everything and move there. This is where I want to be.
A lucky country.
Very lucky.
Yeah, it's a lucky country. Get into it. If you're not investing in property, start today. That's what I'm told. That's what Paul Glossop tells me in Pure Property Investment, by the way. But we're not here to talk about geopolitics. We're here to talk about what's making... Well, it's sort of making property news, but maybe that could be a PhD thesis for someone out there.
What?
Conflict in the Asia-Pacific and the ramifications for property market dynamics.
Well...
Maybe that's my calling.
You reckon? A PhD student
doing that.
Look, I'm sure there's well suited for it.
There's probably some academics out there who have looked at if there's some academics out there, if you know of any academics who have looked at this, get them on.
You'd have to think there would be, to be honest with you. You would
so.
have to think there's probably dozens and dozens of different studies that have been done.
You would think so. What would happen? But we've had an interest rate cut.
We have another.
Yes.
And only as of this week, we saw inflation data insipid for the March quarter.
Insipid. That's a big word for you.
It's not a massive word. It's not a regularly used word.
It's a little bit more sophisticated.
Slightly more sophisticated.
Yeah.
But again, like now we're seeing that July RBA, pundits are penciling in pretty much a guarantee for another rate cut in July now on the back of one in essentially only less than 6 weeks prior to that. So here we are. We've got 2 in the books already for 2025, likely to be a third within the first 6-7 months.
What was CPI data?
I'd have to. I think it was 0.2.
Stable.
0.2% for the quarter.
Okay.
Yeah. It's low.
So it's in the target band.
It's below target band. Yeah, absolutely. And when you look at the per capita, and when we're starting to look at that rate, that's starting to show that we're technically in a recession when we're looking at the actual per capita rate, and that's when it starts to get complicated. And I think
it always lags, right?
And
this is the challenge for politicians and the bureaucrats who govern the country. You're often you're often seeing the results of decisions in the review mirror.
Absolutely.
And then but the secret is working out pretty quickly where. Maybe we've gone a bit too far and ameliorating that as quickly as possible. But often, and historically we haven't got it that right.
Yeah.
So hopefully we try and mitigate those mistakes again. You know, the official cash rate, the Reserve Bank cash rate is a mechanism to stimulate the economy or slow down the economy. So sometimes it gets slowed down too much. If we jump on it quick enough, that could be, you know, a positive result. But anyway, irrespective, there's pros and cons for property investors as a result of that. So with each cut that happens, say call it 25 basis points, and whether or not we're going to stay on this cadence of 25 basis points, because we're in a weird number at the moment. It'd be nice if they just even it up so it's all divisible. Every percent is divisible by, you know, so these strange outliers. But the impact of that for most Australian borrowers is largely immediate. It might take a couple of weeks to flow through where you're, and if your lender chooses to pass on those rates, you start getting a few more bucks in your pocket every month because your interest rates have gone down. Now, a lot of smart operators, depending on what you're doing, will keep their repayments the same and use that as a paying down debt scenario, one thing. And you can always, if you pay down your debt, that means you've got more you can extract anyway with equity. But one of the other aspects of it is that increases serviceability.
Exactly. It's a direct correlation. The lower the interest rate is, the more you can borrow. And that's regardless of your income. If your income stays the same, but the cost of money gets cheaper, incrementally that increases how much you can borrow based on the algorithms that are used for serviceability. And, you know, to put it in perspective, every rate cut of 0.25% is depending on the bank's policies, etc. But it's circa 2 to 3 times or 2 to 3% more you can borrow every rate cut.
Every 25 basis points.
And that starts then you start to forecast out. And now the forecasting is looking like about a 1% rate cut in total by this time next year, or to put in perspective, say circa high 2s to early 3s official rate from where we are now at 3.85. We're going to get to the point of retail rates going to be high 4s to early 5%. And anyone who's got money that's lent or borrowed right now, they'll probably know that they're paying anywhere between high 5s to early to mid 6s, depending on your structure and investment, P&I, interest only, etc. So that works out to be about 10, 15% more borrowing capacity for someone who's buying their first property to someone who wants to buy their 50th property. Yeah. So when you couple that with the things we were talking about a second ago, which is low supply, consistent higher demand, and a well and truly undersupplied national housing market. When I was talking about the opening, mate, that were sort of a little bit more buoyant this year versus the last few years, I can see the writings on the wall. It's a lot clearer.
So what you're saying then, for a simple bloke like me, is that prices will increase?
Prices will increase, unfortunately for some, fortunately for others.
Fortunately if you have them, unfortunately if you're trying to get into the market.
Correct.
However, for all the reasons you've outlined, you may be able to get into the market faster as a result of it. So it's absolutely a chicken and egg type.
It is a bit of a chicken and egg
scenarios.
type.
I don't know anyone who has real estate that wants prices to be more affordable.
I'm not necessarily too familiar either.
No, they seem to exist.
these
and you see how quickly someone's attitude changes from I can't afford to get into housing to I'm in housing right now. They're looking every day, getting their calculator out, trying to work out how much they've sort of gone up. The challenge you have with this though, and this is what most Aussie investors need to be conscious of. Just because you can borrow more doesn't necessarily mean you should be buying more expensive real estate.
That's a good point. And sometimes it's hard to avoid though, right, Phil? Because as prices of money come down, prices of assets typically are going to increase. So you're not finding those markets that we're buying in 2018 to 2022 that I know personally I was buying in markets where I could buy a freestanding house for circa 270,000, 350,000, somewhere in between there. And I can tell you we bought a lot of property in those price points. That same property is 600, 650, 700. Doesn't mean that 650, 700 price is too much. Well, not necessarily. It means that that's the price. But as prices of money come down, then ultimately the price of property goes up. But you still have to then think about which cohort of actual prices do I focus on. And the thing that has probably resonated with the core logic data over the last 3.5, 4 years in particular is that lowest 25 percentile band has outperformed the middle 50 percentile and the upper 25 percentile.
And one of the challenges with that, and for a lot of property investors when they start investing in property, typically they'll be investing, and I'm saying typically, like there's outliers, but they'll typically be investing in that bottom quartile. The issue you have there is that's probably one of the more competitive markets in Australia because you also have first-time owners competing in that market and also homeowners in general. And when you look at what's happened over the election cycle is now being implemented, a lot of the policy direction is towards housing affordability. What it's manifesting is less than affordable housing because you're putting the pressure in the area where you probably least want it. You've got all these incentives coming downstream for first-home buyers, which I think start 1 January.
Yeah.
There's incentives starting at the start of July. You've just had all this HECS forgiveness stuff. You've had all this...
which helps serviceability for a lot of people, by the way.
It does. And you now have lenders like CBA who are taking a different view of HECS debts, right?
Correct.
So on double side of the ledger where you've had 20% wiped off, and also if you're within a year of paying out your HECS debt, the bank doesn't assume there's anything, right? So you're putting even more pressure on those competitive price points.
What are you saying, Phil?
What am I saying?
What's going to happen? And we talked about this off air.
It's a housing crisis. It's a housing crisis.
Oh, one of the best terms I've heard out of the last 5 years. We're in a housing crisis.
Everything's a crisis.
It's a crisis.
Cost of living crisis, housing crisis, affordability crisis.
It's a crisis.
There's there's crises everywhere. But this is the point now, right?
Yeah.
Like, and this is a mindset thing. And I know you speak about it in your book, which I've got to point to everyone over here.
Over here.
Yeah,
Right there.
There it is.
Right
there.
Yeah,
This whole
somewhere
mindset thing, right? And back to our earlier point around geopolitics and all that as an example.
Page 23.
Oh, there you go. Mindset.
Mastering the investor mindset.
There you go.
Right there, people.
Wow.
You can order that, purepropertyinvestment.com.
So I'll give everyone
free copy.
the Brody's Notes. Does that still exist? The abridged version? Remember Brody's Notes? You'd read that little book at school and tell you what.
I do remember it is. But I do have an audio book, which is me reading this out if you don't want to read it all, and you can skip to certain chapters as well. Yeah, if you want to listen to it in the car. But there, bam.
If you go through life thinking everything's a crisis, you're probably not going to be able to shift your mindset to take action. So
just going back to that, I've noted this one a few times, but Confucius say, man who run behind car gets exhausted.
He does get exhausted. It's true. So our politicians across the spectrum need to stop peddling this idea of a crisis. If they're going to show true leadership now.
Oh, here we go.
No, let's listen to this, right?
I'm listening.
So you get to make a choice as an investor. It's the mindset thing, right? You can tune into that, and everything is a crisis. There's a crisis of supermarkets. They're gouging you. There's a crisis at the fuel pump. There's crisis. Mate,
Dairy farmers are getting gouged by the supermarkets.
They're getting gouged, mate. Your pack of lungies is getting expensive. They're now going to start taxing like Alco Pop stuff even more. There's crises everywhere, right? I think Australia needs to have the maturity now of saying it's not a crisis, it just is. We'll look to try and fix things, right? But to the point, housing affordability crisis, housing crisis. Now there is a crisis in people not being able to find homes to live in, right? With homelessness and that. I say that
is legitimate.
Legitimate, right? But we're manufacturing all this pressure in this lower quartile, which is only going to make things even worse. That's not a crisis. That's the market. Now nothing is really happening there to change and shape that, which we'll talk about in a moment. So as a property investor, just don't think it's a crisis. Think it's a ground for exploitation.
It's an opportunity.
You got to go, this is the way it is. Like it's called situational awareness. Okay.
Yeah.
I know what's going on now. Now I look to play the right tactic in the right market at the right time.
Don't expect something, especially government-led, to change what is happening now and what has happened for a very, very long period of time. And that is ultimately where we are, and I think will be for an extremely long period of time, is that we are in a shortage of property that can only be...
It's a status quo.
It's a status quo, and the only way it's going to change is if private investors buy more investment properties.
Yeah. It's a status quo.
And develop more property.
Look, it may change a little bit on the fringes, but it is status quo. So there's not going to be any changes coming downstream other than there might be a few more interest rate cuts. So you save a few bucks, maybe another 50, 75 basis points over the course of 12 months, maybe. I'm not an economist. Structurally, the government's going to stay as it is.
Yep.
You know,
they'll try to tax you a bit more here and there.
yeah, they're trying hard.
Yeah, they're
trying hard. So
Yep.
there's going to be, fringe stuff, right? So you know what's going on. So if you've ever thought about taking action, take action. But putting all that pressure at that lower quartile, and the question is, well, maybe there's opportunities for investors not to be investing in that lower quartile.
I think there's opportunities
discussion.
across the entire market segment for the forthcoming 12 to 24 months. And if you look through the archives, when you go through cheaper money rate cycles, it does give a ubiquitous uplift. It's not to say that what does happen is when you go through the increases, it does squeeze more people to more affordable markets because naturally they can't borrow as much as they thought they could last year when those rate cuts didn't implement or imply themselves. Now we're going through the opposite. What happens is it actually opens up the slather for everyone. So those upsizers who are going for those from mid-tier to those upper 25 percentile, they typically are the beneficiaries because they're the ones who don't necessarily buy because they can borrow more, but they buy when they've got confidence in what's going to happen to the market and also what's going to happen to the economy, which I think we're still early stages there. We don't necessarily have there's going to be a lot more liquidity across the market. But when money gets cheaper, if it's not coupled with mass unemployment and a recession, you typically have pretty good business sentiment.
Well, you look at the stability, right? Like CPI is stable. I think it will stick within that target band, shades of. To your first point, it's not a bad time to be a property investor.
Yeah.
And when you look at these points here around housing, the state of housing market, last year there was 177,000 properties built on a target of 233.
Yep.
5 years we're expected to build 120,000. So we're going to
1.2
million.
Million. That was our target.
Target. We're going to fall about 30% short of that, about 900,000.
Yep.
And even in April, and some notes here showed a 5.8% reduction in approvals year on year. So we're actually going backwards. We're not improving the situation.
We're not improving. And if anything, this might look worse in a year's time than what it's already on the trajectory to achieve.
Now, so these were ambitious targets set by the government, but from what I understand, that targets are conservative in what needs to be built, i.e. there's not a lot of fat built into it thinking that if we miss it by 30%, it'll all be okay. The target was based around that's actually what we need.
That's what
it's
we
not
need.
like what we need plus 30%. That's what we need. So we're going to fall 30% short. Now, one of the ramifications is that true housing crisis we have, which is people can't find places to live, right? And let's just put that aside for the moment because that's not that there is the obligation of the government to get that stuff sorted out, right? But what we're talking about is what is the ramifications for property investors who are investing in properties as a result of this. Your thesis is prices should go up.
Well, they already are.
Yeah.
I mean, this is the thesis that we're seeing this year in particular. If we compare it to the last 2 or 3 years, when you've gone through these interest rate hike cycles, then stability at the higher price rates, prices definitely across the country. If you stripped out Brisbane, Perth, and Adelaide in the last 3 years, Australian property prices went backwards.
Yeah.
In some cases, quite considerably. In Melbourne, they're still about 1.2% below their peaks of almost 3 years ago now. They're growing, but when we look at then take into account just the last 3 or 4 months, so just this year after you factor in one interest rate cut and now a second, and to be fair, the data is not going to show what's happened from this second rate cut just yet. We're starting to see every single market showing increases in value, and that starts to point towards the signs of what happens because that's not necessarily led by just supply and demand. That's led by more where the money gets eased up and more people have confidence. Plus, there's still demand. I mean, there is no, and going to this State of Australian Housing Market report, there is not a single major capital city in Australia that has had adequate property built to meet the demand based on that report. And if you go drag that out, you can get that on the archives. You will see that it's pretty clear that every single major city in Australia today has an undersupply of property. And that's a problem.
And the challenge with this, and we go back to this notion of crisis, right? Depending what your variational version of a crisis or definition of a crisis is, there's a crisis in building. There's a building crisis. We're not building enough housing, right? But it feels as though no one really is taking ownership of it. So you throw these numbers out here. We were we did 177,000 houses on a target of 233, right? If you were a business, CEOs would be sacked.
Yep.
On that basis,
Yep.
right? Like, they would be accountable, responsible for it. Everyone is just like, well, it's the other person's fault why we haven't sat there. I would say for the Prime Minister, who's absolutely in charge of
this show as well.
Yeah, I'm sure he does. He probably listens to it when he's walking his dog. PM, like, someone's actually got to take responsibility for falling so short. And it's okay to say, the reason why we haven't fallen short is that we have this crisis, this crisis, this crisis, this crisis. That's fine. We know there's crises there, and we know all the reasons why we have these crises for people who are into their grammar. But it's like, well, we've missed it.
Phil,
we've missed it again. We've missed it again.
But you've got to take, and you're a cynic with the best of them. I know you are, and so am I in certain ways. And I look at this, and this isn't even trying to be coercive and trying to be clever. I think personally these are numbers that were talked about because ultimately you look at the ABS essentially says this is the number, and that's where this number comes from, is that we've got this amount of people, this amount of houses, the average is 2.2-ish people per house, therefore we've got a shortage of X. And then we need to build this amount, 1.2 million, to then meet this total target. That's where this number comes into fold.
Yeah.
That doesn't mean that they talk about, or the government's set an ambitious target to build 1.2 million. They said that top line, but they didn't say how they were going to do it. It was never going to be, hey, here's how we're going to do it, and here's how it's going to stimulate economies, and here's how we're going to meet these housing targets, and then essentially put a bed or a base to how prices can't necessarily go up in value. The government doesn't want prices to go down in value. If they meet these targets or exceed these targets, they know what happens.
Mate, you say you're not a cynic.
I know.
Mate,
I said I'm going
to
be the cynic for this moment in time, and I think anyone who's sitting here listening.
Well, the government now co-invests with Aussies.
This is exactly it. So they are doubling down on this narrative. So it's not going to change. If anything, now we are so much entrenched. It is going to take something that we have never, ever seen in this country to change the fact that prices are going to be linked to people's net worth. And that is going to also be linked to people's retirement. And it's also going to be linked to the ability for government to stay solvent so they don't have to put their hand in their pocket to support so many people going through pension phase. Like it or lump it, property is going to be the main way that most people are going to create wealth for the rest of everyone who's listening's lifetime. So if you're not getting involved in it, you are going to sit back and you're going to be that person who unfortunately is going to be 5, 10, 15, 20 years, however long it is between now and retirement age, you're going to think, man, I probably should have got on that when I could have because I relied on the superannuation funds.
Hate the game.
That is exactly what it is. Because
let me clarify this. So what you're saying is that there's a bloke sitting there or a lady sitting there with a tap. And they sit there and go, I'll turn it back a bit because we can get prices up a little bit. And the higher the prices are, that means we're going to make more in our taxes because it's got to cost more. We can tax them more because there's land tax. We can tax them more. Is that when people are buying properties, they're going to have to pay more. So and they go, actually, it's a bit bad now.
Too bad.
Open it up a bit, let it flow a bit, bring it back.
Yep.
The banks are getting a bit angry because
or demand's dropping, or bring more people over into the country. Phil,
that would be a great cartoon. Imagine that, like a Looney Tunes type
those
thing.
Cartoonists of the Fin Review and Co. I've probably missed a few over the years, but I dare say that's probably on their minds. But yes, Phil, you're right. That is exactly what I think is happening and happens. Certainly not on a cynical basis like that. And I don't think anyone...
Does it happen because of just ineptness? Like they're just not good enough to actually work it out?
Or
is it really
it has to be deliberate, Phil. Like it has to be deliberate because not just for the selfishness of a politician who has a pension that's attached to property that's got an investment via a superannuation fund that buys REITs and all these other things that go with it. That is systemically already the case. But we go through this data time and time again. Out of 100% of the property investment market or the property market, a third own their property outright, a third have a debt on their home, and a third are property investors. If you break it down to real simple numbers, when it comes down to it, it's worth $11 trillion more now. It is 3 times the superannuation fund value. Now, if you drop that by 1%, you can start to see that this butterfly effect is real. We are so attached to it, and it's going to be that way forever. So you start to tinker with the property market. You start to tinker with everything.
And this is what your sort of bong-smoking hippie mates but they'll say that this, they'll go...
How did you know?
But this is when they go, this is corruption. They'll call it. This is corruption.
Well, maybe if you want to...
But it's the system.
It is the system. But again, I mean, this is the difference between, I dare say, the people who are listening to this show.
I don't think it's them, by the way.
Well, I don't think it is necessarily either. But I also think that it comes back down to when you're 18 to 25 years old, you do have a different view of the world. Yeah. And we've been there, Phil. We go through the university scope, you go through life, you travel, you speak to people, and you talk about all those things that utopian society should and could have, and it just all becomes very much, Hare Krishna, and everyone does enjoy the fact that we all just help out each other. And look, don't get me wrong, I love living in a community where I can help people, they can help me, and we all work together. But when it comes down to people's values of how they make money and where their life's going to be based on security of funding, property features at the number one. In Australia, it is by a long way the top of the tree.
So what your counsel is to our listeners who are obviously probably invested in the idea of wealth creation is, that's the game. Play it as well as you can. Yeah. Because they ain't going to change.
And you're right, Phil. If you want to use sporting analogies, people talk about a lot of our major sports, major sporting codes in Australia, whether it's netball, AFL, NRL, A-League soccer, cricket. The games have, by the most part, been the same for a very long period of time. You know what? Every now and then, rules change a little bit.
Yeah.
But still, people want to go and watch the sport that they love, and that sport is still the same game. It is the same with the property game. Yeah, there will be there'll be tinkering on the edges. There'll be things that'll change from time to time, but for the most part, you're watching it and you're playing it because you know what's going to happen and you enjoy the outcome.
I went to the footy the other day.
That's probably the first time. Which footy?
The NRL.
Oh, which one?
I went and saw Manly play the Broncos.
The Broncos. Oh,
at Brookie.
At Brookie. It would have
Four
been all
Pines
right.
Park.
Brookie's getting it. They're heaving these days.
It was packed.
Yeah.
Like,
you're going to get back down there a bit more often. Were you on the hill? You would have been behind glass for sure.
No. We actually went there to go on the hill.
Couldn't get there. Had to go back behind the glass with security.
No. We stood behind the posts at the at the eastern end.
Okay.
God, yeah, busy.
Good.
The game hasn't changed that much.
No, it hasn't.
They seem a lot fitter these days.
There's a lot
probably
more running.
A little bit more professional.
Yeah. There's a more athletic.
And the biggest sideshow are those idiots on the hill playing play it. You know that new run it straight thing now.
It's certainly not my game.
Yeah,
but it's heavy.
Anyway, that's it. The game is changing. Yes. But good to get out of the Brookie, vibrant. But so that's the reality of it, though.
It is.
So you can choose to be a participant, or you can choose to sit on the sidelines.
And we're not here to convince. I mean, I think by virtue of people listening to this podcast, they already get that message, right? Yeah. So if you're trying to be convinced of it, I think go and rewind the last 20 minutes of what we've talked about. And I think you'll probably, and go do your own fact checking on what we've talked about. But I'd be very, very confident in what we've talked about.
It sounds really depressing, though, really. Like, depending which you sit there and just go, well, that's a bit of an unfair advantage Australians that can invest in property have.
And that's the part which I think a lot of people...
It's a mindset thing.
Yeah, that is the big one. Because you and I, again, Phil, I mean, I don't want to talk about the fact that we didn't have opportunity. We did. By virtue of being educated and born in this country, we had what we had. We definitely didn't have much to get started. I know getting started, I bought sub 200 grand back in the day. And I've literally, in my own super fund, I'm going through 2 sales right now to recycle that into 3 more purchases across the Victorian market.
Don't go above 3 million.
Well, that'll be debated more and more.
Important point around this. Let's just clarify that. That's so if you've got a self-managed super fund.
Yes.
From what I understand, that's $3 million per person.
Per person, correct.
So if there's 2 people in your super fund, that's $6 million.
It's
hence the reason why this is only. The argument is only really affecting 80,000 people now, whether it gets indexed or not. So just to clarify that point. So most people have probably still got a long way to go in terms of maxing out there.
And if you've got net assets of $3 million and then they're talking about increasing the tax from what I think is from 15% to 30% above that amount, it's still only...
I think it's gross assets.
Gross. So it takes into account the entire portfolio, does it? So it's not a fringe above that.
No. Okay. If the house is worth $800,000, it's $800,000. Not $800,000 less $500,000 in debt.
No, yeah. So let's say it's gross assets. So let's assume it's gross assets, but they're not. Is the plan? And correct me if I'm wrong here, but the plan isn't to tax your net
Only
value.
over.
It's only the over. So anything below still stays at the current taxable rate. Yes, correct.
From what I understand. Speak to your accountant. But
correct. Yeah, and look, I mean, it's going through scrutiny in the Senate at the moment, and whether it gets watered down or not. For me, look, Phil, I think if you're privileged enough to have $3 million in gross assets in your superannuation fund individually, you've done well to get there. Secondly, I think anything above that and you get taxed more, as much as it's not what you signed up for initially, when the goalposts change without you having control of that, that sucks. And I think for me, that's not the way that a democracy should really work. It should be grandfathered and there should be some concessions in place. The pub test issue I have, and I say this with no allegiance to one side of the ledger of politics or the other, but when you genuinely can't have an answer to how this doesn't affect your own superposition as a poly, that sucks.
it's carved out.
That doesn't pass the pub test.
It does pass the pub test.
That's the part which like. It's stupid from a political standpoint that they didn't think about that, and I couldn't think realistically that any poly thinks that that's fair, just because they're a politician and that this is what we've just decided upon. Yeah. That's silly.
Well, fortunately, some of the retirement perks for polys were wound back, I think, under Howard's.
Yeah, and they have to be. The job sucks. It's a horrible part. I actually had I was at a soccer game with my son only on Saturday, and I ended up speaking to a federal member who just ended up shaking hands, and we were just watching because his son was there with me. And we're talking. I ended up on the topic of it somehow, and I don't really know how it ended up that way, but I could tell in the first part of that conversation, he went straight into his shell, and he's like, he wasn't comfortable about it, and I could tell he didn't have much ability to
about the carve out.
And you could tell he wasn't. It's just simply he didn't want to voice it in the sense that he's like, I don't agree with it, because you can't necessarily say that.
Toe the party line.
But I could tell immediately he's like, it's not good.
Doesn't pass pub test.
It's not good. And that conversation basically stopped there, and he's like, it sucks. And
back to the football.
Back to the footy. And I think anyone who's in that position, they'd probably all be looking at it saying, look, we'll probably have to we should definitely be making some changes to this, because if you want to put a target on you for the rest of this term, you'd go ahead with that policy. But if you've got to repeal either that part of it or part about the super profits tax, or a combination of the two, because it doesn't make sense. Anyway, time will tell.
So what happened to property in April then?
So
did it go up or down or left or right?
Certainly gone up. So this is probably when we look at where we're going for this year, and probably for the listeners to say, okay, well, great. I'm aligned to the fact
April being the most up-to-date data.
It is most up-to-date data we have. Yeah, correct. So if I look at it and say, well, what happened from CoreLogic's or Coality, as it's now known, or will be known, anyone who's referring to or hears Coality jargon around, that's essentially the rebranded CoreLogic, and CoreLogic was RP data. So track it back to its original sources. CoreLogic or Coality data showed that there was about 0.5% growth across Australia in the month. Sorry, it's the month of April, not April, it's the month of May. So this is May data. Yeah. But 0.5% growth right across the board. In that, we saw every single major city saw growth, as well as the market of Darwin actually showing now 3 really good consecutive months on the back of a very average 10 years. But that was leading the charge at 1.6%, with others posting the least was 0.4%, and then everything else was in between that.
So essentially, the worst performer is that your property went up nearly 0.5% in 1 month.
In 1 month.
Yeah. And that compounding starts to
5-6% annually if you compound it. Yeah. And then you look at it. We talked about this a little bit earlier, but it's only now Melbourne and Canberra who are sitting below their all-time highs. Melbourne's still about, as I say, 1.2%. Canberra's about 0.7% below their all-time highs, but that's changing. It won't be long before Melbourne, I would probably peg it as 1 or 2 months away, will be reaching its all-time highs once again. And I dare say Canberra will probably be aligned to the same time frame. Everywhere else sitting at all-time high price points. Now, this isn't the share market, right? This isn't saying, are we in a bubble and is it about to burst? Property doesn't move that way. Property moves slowly, consistently, and predictably. And that's what we're starting to see now, is month on month, considerable, slow, predictable growth of 0.4 to 0.6%. And with another rate cut, which doesn't influence the numbers that we've just seen, that's going to flow through. Now, with also the likelihood of a July rate cut, that also doesn't factor into this data as well. The likelihood of potentially 2 more rate cuts after that, as far as what's being penciled in, maybe 3. This doesn't factor that in to what's already happening. We talked about that 5.8% reduction year on year for April construction numbers. This doesn't factor that in. Supply is low. It's getting lower compared to where demand is. Money's cheap. It's getting cheaper. Prices are growing. If we look at capital city trends, they're converging, and the gap between the highest and lowest changes, 9.8%. So this hasn't been close. It hasn't been close since March. It hasn't been this close since March 2021. So that's probably something that I think is something that's an interesting sign to show that we've got this ubiquitous uplift versus where we had certain markets that were really, really underperforming, other markets which were outperforming. We've now seen this much more of a consistent uplift across the board. And probably the other one that's worthwhile really pointing towards here is that regional markets are still being really trending positively. And if I'm honest, Phil, as a property investor and a property researcher in general, I look at data all day, every day. I personally didn't expect regional markets to be as robust as probably what they have been in the last 3.5 to 4 years post the peak of the COVID sort of sea change, tree change. I personally did expect that we would see, and don't get me wrong, I mean, you'd see it in your office, Phil, is that you're back to full capacity, right? Like people work in the office. So you'd think that that general trend pulls people back away from being able to work remotely on more of a full-time permanent basis. And ultimately you'd expect that to affect the demand for property in those areas. Hasn't been the case. They've still stayed consistent. Now, they saw a tear. Regional markets were outperforming every other market segment for 2 years there. Now they're pretty much in line with the major metro markets, but I expected them to probably come off a lot harder than what they have. And I think that's a good thing for Australia, is that we're seeing that there is more sustainability across more markets. And I think a lot of that's been buttressed by the level of demand, not from the domestic, but also the overseas, because we also know that when people do migrate to Australia, they have to push to a lot more of those regional markets for their visa purposes and for jobs, to find jobs and jobs creation, because there's typically more vacancy and opportunity in those regional markets for those initial 1 and 2 years worth of jobs as well.
And rents are typically, when property is universally rising, rents stabilise, right? You know, we've gone through this cycle of increasing rents. So I think we're probably beyond that rapid growth now in rents.
I think so, man. And I mean, the data's pretty obvious to point towards. We've gone away from these, and that's helping the inflation story too, because that was a big problem with the inflation story, is that they didn't want to cut rates because they knew that this was going to put all this pressure back on that space.
Most of my renewals now, they're saying, it's about right.
About right,
don't change it.
Yeah, and don't spook the tenant, because vacancies are starting to go from 0.2, 0.4%, basically zero vacancy in suburbs to probably more around that 1.5%, 2.5%, which is still a balanced market, but that's where it's starting to become more obvious, is that, and I think that'll remain a pretty consistent trend. We're going to go, I mean, we had 10 years of more or less no rental growth, well below CPI.
True.
And this was pent-up demand. This wasn't some sort of expedited demand based on a huge amount of people coming. It was just more so because, hey, prices got real cheap, and all of a sudden we had the ability to raise rents because there was more liquidity in the market, and it hadn't happened for a long period of time. So I think we've now actually, if you look at 20-year rental growth trend charts, they're really interesting, because you start to see the point A to point B. It goes there, then up, and then back down, then up, then back down, and it's kind of now tracking still towards that 2 to 4% band annually, which is the long-term trends, and that's where we're back into that band of now.
All right, well, lots going on then in property news. So next time the RBA gets together is about 4 weeks' time, I would imagine. 4 weeks or so. And the mail at the moment is down, but you never know what happens in a month.
You don't, but I think it's penciled in. It's more or less penciled in by a lot of people. So
what's the markets saying? You know, everyone looks to, is it ABS?
RBA rate tracker.
RBA rate tracker.
I think last I looked yesterday, it was 81%, and I think that was before the inflation quarter, the March CPI data came in. So I dare say after that data of 0.2% for March quarter, I would expect it's probably more like 90%. Let's have a check while we're going here, Phil. You fill in some filler noise.
Well, hopefully I haven't really seen those CPI changes at the checkout, stuff still feels really expensive. But maybe that's just the new normal. You know?
I think to be honest, I think that is where we are. We've got a baseline, and that's on build costs. That's on a range of other things that go with that.
Petty doesn't seem that bad though. I remember petty being petrol being more expensive. Like it feels like it's. I buy diesel, right? And it feels like it's about 20 cents cheaper.
I'm an EV guy, so I don't know.
Oh, yeah. One of the fancy people.
I don't know if it's fancy.
You guys are wrecking the environment.
Jesus, I'm just a bloke trying to just be self-sufficient. I've got solar panels and a battery, and I just try to charge my car from it.
Yeah, I saw a guy at the petrol station with an EV fueling it up, and he went,
putting diesel in
his
car.
How's that? And
torching
he went, man, never buy it. He didn't look happy.
Yeah,
didn't look happy.
Standard.
Anyway,
I've got it updated here. So I did say yesterday was 81%. Today's 86%. Yeah, expectation. So you start to, if you're a betting man or woman,
when do you start doing the math? Going, I've got a bit more serviceability. I'll just wait till that happens.
Well, this is where, for me, if you're not taking action when you can see these things on the horizon, just expect to pay more. Don't get upset when you get your ducks in a row and 6 months down the track after there's been another rate cut, potentially 2 more rate cuts, plus the impact of the last one that's just happened, and you can start to see we're on a cadence of 5 to 8% capital growth in a lot of markets. Potentially some will be above that for the next 12 months.
Happy days.
Be expecting to pay more if you're going to wait 12 months.
Now, speaking of procrastination, what's going on with this? Last time I saw you had some new tool or thing you've created to help
the pure property plan.
The pure property plan.
Look, it's
updates?
Not procrastination. I can assure you of that. I've got a meeting with my financial advisor who I'm working on this with as of tomorrow to actually go through. Probably it's about version 6.9 at the moment.
Okay.
A lot of data inputs. We've done 4 separate tests to 4 separate, call them guinea pigs, but they are large scale property investors. So we actually wanted to run the simulation through a lot of people who have actually gone through this and want to actually get.
Have they got the report?
That 3 of the 4 have. Another one's doing it today. So the intention of our meetup tomorrow is we're going to get the feedback from the 4 as to the process from start to finish, the inputs, what they take away from it, to make sure that we're actually tweaking everything to get it correct. Because what we've got now is the ability for people to know a few key questions. Is that when will I be debt free? And when can I retire? That's a big question. And we want to be able to plug inputs in to give people some assurity to say, within reason, based on everything that's happening, here's where those numbers will be. How much investment loans will I have at retirement? So what's my debt going to be? What's my debt position going to be on investments? Things like, what's my passive income going to be if I push to this level? How much income will I have? Factor in tax, factoring in expenses. How long will my income last into retirement? So, these are some of the key questions that if you're buying property, it's great to get an outcome, but you want to know what you're working towards. So we've got essentially all of this information that we're plugging in, whether you're starting and you haven't got any property or you've bought your 6th property and you're trying to figure out what it means from here. The intention is that we want to get you through this property plan to then get a document that's going to give you an actual next step. So are you where you need to be? Do you need to add another asset? When do you add the asset? How much should that asset be? Is it cash flow? Is it growth focused? Is it resi? Is it commercial? How does super couple into this? When do you add more money into your super fund? All these other things. There's so many different inputs.
So it's actually a plan.
It's a detailed plan. Yeah. So if anyone does want to get their hands on it or wants to go through the process to actually get this outcome, well, I reckon we're probably a number of weeks maximum away from being able to get this started. So
insert 2 months.
Insert 2 weeks. Insert 2 weeks. Hold me accountable to it, because by the time this time next month.
Next time I'm going to ask you.
By this time next month, Phil, I expect that we'll have people going through the process.
Do I get a free plan as a guinea pig, or you get to charge me for it?
There's no such thing as a free lunch, Phil.
So it's got to cost money.
It's going to cost you money, 100%, twice as much as what others people.
Twice as much for half the output.
Plus lunch.
Plus lunch.
Look, the finance, the cost side will be elaborated once we actually figure out how much time is going to go into it. But it is a fair body of work. But I can tell you,
so it's actual like a financial plan.
Correct.
It's not like Paul just getting his calculator. Right?
No,
it's
it's
like
saying,
someone with
you're in good shape.
This is someone with the
turn the calculator upside down. Shell oil.
A proper. There's another 7734.
But yes.
So like a real deal financial plan.
This is and we've done it in collaboration with a whole bunch of different inputs. So it's not a boffin who doesn't understand. It's someone who's going to understand the actual person themselves and try to figure out all the inputs individually. So if you do want to get on that shortlist to get this started, we are taking shortlist names for people to go through the first cohort. So inquiry at purepropertyinvestment.com. That's inquiry with an E at purepropertyinvestment.com. Just say your names, contact details that you're interested in getting in the shortlist to get started with this plan. We'll reach out probably within the next 2 to 4 weeks. We're early to mid-June right now, so just for a timestamp for those people who are wondering when this is. And the intention is that we want to get people through this as quick as possible, because the more people are empowered with this, more people are going to make better decisions, more people are going to get to that retirement outcome as quick as possible. But separate to that, and I think more importantly...
question for an accountant, that would be tax deductible, I would imagine.
Question for an accountant, but I dare say it would be. Yeah, absolutely. You're investing in your financial outcomes for sure. Yeah, so... I think, though, more importantly, for those who are probably at a point where they're like, okay, plan's great, but I need to take action if I'm going to get anywhere, that is the point which most people, you need to take heed of all of this data that we've gone through today. If there was ever a time in the last few years that I look at to say it is actually pointing towards a ubiquitous, strong uplift, if you have capacity, you need to get moving. If you don't know if you have capacity, speak to your broker. Yeah. But if you're ready to get moving, reach out to us, 1300 98 5428 or inquire at purepropertyinvestment.com. Let us know that you're ready to get started. We will book in some time, speak directly with myself or Aaron. And the intention from there is to really lay out what that strategy criteria should be and get moving.
Okay, good. It's a nice way to put into application all the things that we've spoken about today. So I think the case is clear for property per Paul's analysis and thesis around all the reasons why there should be positive pressure on capital growth. It's where you buy and how you buy. It's going to be completely determine how well you go at that. So make sure you speak to the crew over at Pure Property Investment. Paul, good to see you again. We'll see you back again next month. And to all of our listeners and viewers, thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.